Hey, welcome back. It's Jason Walter here. The Federal Reserve Bank of New York actually just released a quarterly report for household debt and credit. And they noted that total household debt surpassed $16 trillion in the second quarter of this year. And mortgage, auto loan, and credit card balances increased greatly. So for example, total credit card balances in the US saw the biggest increase in more than 20 years. So in today's video, I'm going to take a deep dive into this because this has implications regarding our economy and therefore our housing market. And of course, if you guys get any value out of today's video whatsoever, then please hit the like button. I greatly appreciate that. And with that said, let's go ahead and dive right into the video here. This again was published today, which is the 2nd of August. And this is according to the Federal Reserve Bank of New York. And this is their quarterly report on household debt and credit. And in this report here, they saw an increase in total household debt in the second quarter of this year, increasing by $312 billion, or a 2% increase. Balances now stand at $2 trillion higher than at the end of 2019, obviously before this pandemic. And check this out, credit card balances increased by $46 billion in the second quarter of this year. It says, although seasonal patterns typically include an increase in the second quarter, the 13% cumulative increase in credit card balances since Q2 of 2021 represents the largest in more than 20 years. Meanwhile, auto loan balances increased by a solid $33 billion in the second quarter, while student loan balances were roughly unchanged. And in total, non-housing balances, that basically excludes mortgages, so non-housing balances of credit, grew by $103 billion, the largest increase since 2016. Also, mortgage originations slightly declined in the second quarter, which coincides with a decrease in home sales across the United States, which that actually makes sense. Also, the second quarter of 2022 showed robust increases in mortgage, auto loan, and credit card balances, driven in part by rising prices. While household balance sheets overall appear to be in a strong position, we are seeing rising delinquencies among subprime and low-income borrowers, with rates approaching pre-pandemic levels. And more on that here in just a little bit. Also, the share of debt that went from current to delinquent actually increased modestly for all debt types, but remains historically very low. Okay, let's talk about housing debt. So there was approximately $758 billion in newly originated mortgage debt in Q2 of 2022. And 65% of these borrowers had credit scores over 760. Only 3% of these new mortgages came from subprime borrowers, a sharp contrast to the 13% average seen between 2003 to 2007. So in other words, approximately 65% of people who got mortgages in the second quarter of this year had credit scores over 760, vastly different compared to 2003 and 2007. And have a look at this. This is mortgage originations by credit score ever since the first quarter of 2003. So from 2003, basically all the way until 2007, 2008. Take a look at this because the share of people with credit scores less than 719 was far greater than compared to now. So the light blue line up here is for people with credit scores over 760. In black is for credit scores in the range of 720 to 759, still a very good credit score. But take a look at this, because for credit scores in the range of 660 to 719, that represented a fairly significant share back in 2003 to 2007. Also, we saw a high share of people with less than 660 credit scores as well. And fast forward to now, look at how many people have credit scores over 760. Also, when looking at credit scores less than 660, it's basically non-existent. So the people who are getting mortgages right now, whether they're doing a refi or they're buying a house, the vast majority of these people are well-qualified individuals because they have high credit scores. Something I found to be very interesting, though, is that take a look at this versus people getting auto loans. So again, the vast majority over 760, but look at auto loans. These are auto loan originations by credit score ever since the first quarter of 2004. So over the past 7 years, a lot of people are getting auto loans with credit scores of at least 760. But look at this though, because basically for this range right here, which is 660 to 719, that's obviously far higher compared to 2004 to 2008, and also compared to 2010 especially. Also, the volume of auto loan originations for people with credit scores of less than 620 is obviously very elevated as well, basically in line with 2004 through 2007. But look at 2009 through 2011, the volume there is far lower than we have right now. Anyways, I thought that was interesting to bring up because we're seeing people buying mortgages right now. The vast majority of credit scores above 760, but that's not necessarily the case when looking at auto loans. All right, so going back to this original report from the New York Fed here, it says, although foreclosures have been very low due to the moratoria and also because of the mortgage loan forbearance programs, 35,000 individuals saw new foreclosures on their credit reports in the second quarter of this year. That's an increase from 24,000 in the previous quarter. This potentially suggests the beginning of a return to more typical levels. Also, the share of mortgage balances 90 days or more past due remained at 0.5%, a historical low. In regards to student loans, about 5% of student loan debt was 90 days or more past due or in default in the second quarter of this year. Here's something you guys should be aware of though, because this low level of about 5% of student loans basically being in default, 90 days or more past due, is a low level because of a decision by the Department of Education to report current status on loans eligible for CARES Act forbearances. So in other words, if you have a student loan and you're 90 days or more past due, but you are part of the CARES Act forbearance program, then the Department of Education may report you as current and not delinquent. In regards to total account openings, whether it's a mortgage, a home equity line of credit, a student loan and auto debt or credit cards, total accounts of 233 million new accounts were opened in the second quarter, an increase from the previous quarter, and also the highest level seen since 2008. So what does this all mean and how does this affect our economy and our housing market? Have a look at this. This is also according to the Federal Reserve Bank of New York. It says historically low delinquency rates are coming to an end. It says here total household debt increased by $312 billion during the second quarter of 2022, and balances are now more than $2 trillion higher than they were in the fourth quarter of 2019, obviously pre-COVID. In addition to that, all debt levels saw sizable increases with the exception of student loans. And of course, mortgage balances were the biggest driver of the overall increase. So why are these debt levels increasing? So part of that has to do with rising prices. It says in part, the growth in each debt type reflects increased borrowing due to higher prices, due to, of course, inflation. Prices for both homes and motor vehicles have been rising, and the borrowing amounts have risen in tandem, which definitely makes sense. If home prices are increasing, so are loan balances. And of course, if motor vehicles are increasing in value as well, so are their loans as well. It says here, in fact, the average dollar amount for new purchase originations for both autos and homes is up 36% since 2019. And the effects of inflation is also seen with a rise in credit card balances. It says the $46 billion increase in credit card balances this quarter was among the largest seen in our data since 1999, at least partly reflecting inflation on consumer goods and services purchased using credit cards. Americans are borrowing more, and this is due in part due to higher prices. And it says here, although debt balances are growing very rapidly here, households in general have weathered the pandemic remarkably well. Total household debt is held overwhelmingly by higher credit score borrowers here. And since the financial crisis, mortgage origination has been very tight. And the vast majority of mortgage balances are now being held by borrowers with high credit scores. And they basically say right here, if we exclude mortgages and look at all other types of debt here, we're basically shifting towards higher credit score borrowers here. So here's a graphic showing just that. So here is a graphic showing mortgage balances by credit score. As I showed you guys, the vast majority of people have credit scores over 760 or 760 or higher. We're not seeing a whole lot of borrowers buying houses with credit scores of less than 620. But look at non-mortgage balances by credit score. Basically all other forms of debt, such as credit cards, for example. In the early 2000s, the share of people who have non-mortgage debt for credit scores over 760 was a lot less compared to what it is right now. Also, the share of people who have credit scores less than 620 is quite a bit lower compared to 2008, all the way basically until 2019. And they go on to say the following here in this report. With the supported policies of this pandemic mostly in the past, of course, all the stimulus money that went into place in the early parts of this pandemic here, there are pockets of borrowers who are beginning to show some distress on their debt. The delinquency transition rates for credit cards and auto loans are creeping up. We're also seeing rising delinquencies among subprime borrowers. And check this out. This map below right here depicts the current share of auto loan balances of 30 days or more past due by state. And as you guys can see here, there's a lot of variation by state. And the Fed noted here that this is mostly reflecting differences in borrower composition and in local economic conditions. And as you guys can see here, auto loan delinquency rates is more concentrated in the South. The states right here that are shaded in red represent a higher share of auto loan delinquencies across the United States. And to summarize, here's what the Fed had to say here. While overall credit profiles thus far remain resilient, the recent uptick in delinquencies in some households suggests that many communities or individuals are experiencing the economy differently. We are seeing a hint of the return of the delinquency and hardship patterns we saw prior to this pandemic, and we will monitor these areas going forward. So one thing I want to add regarding this report here is that historically speaking, delinquency rates are still very, very low, but this giant increase of credit balances is something we should definitely be tracking. In my personal opinion, the biggest X factor right now is jobs. If people lose their jobs and lose their ability to pay these mortgages or these credit card balances, that of course is greatly going to affect our economy, and therefore it could affect our housing market as well. So for example, according to fastcompany.com, we're seeing more tech layoffs. For instance, it was reported that Oracle laid off an unspecified number of US workers. In addition, Shopify in July laid off roughly 10% of its workforce, or about 1,000 workers. Netflix laid off about 300 employees in June after the company reported that they actually lost subscribers for the first time in more than a decade and slowing revenue growth. On top of that, Coinbase actually reduced its headcount by about 18% ahead of this economic downturn, and Lyft cut about 60 jobs in its rental division in July. So comment below with your biggest takeaways from today's video. Also, if you guys got any value out of today's video whatsoever, then please hit the like button. I greatly appreciate that. Hope you guys have an awesome day, and I look forward to seeing you on the next video.